So chapter 1, so it is about introduction to financial management. So what is the most important that you need to know in financial management? So it is about the definitions of finance. So the definition of finance uh, will comprise what is the financial management is all about. So the definition of finance, there is few definitions of finance. So when we talk about finance, there are few words that will came across to the people's mind. For example, they will talk about banking system, they will talk about money, they will talk about accounting. So all those words are the reflection on finance. So basically, what is the definitions on finance? So finance is a process by which money is transferred from the businesses, individuals, and governments. So what does that mean? It means that money is transferred from one person to another person, from one people to another people. So how this can be done? It can be done through the transaction. So every day when we do buying and selling, so money will be transferred from one person to another person. So who will do the selling? So basically a businesses. So there are the business who do the selling. As a business people also, they are also do buying. So through the buying and selling, there is a transformation of the money from one person to another person. So these parties, they can be individuals like us, they can be businesses, they are the corporations because they are doing the business. They also can be government because government also doing selling and buying. So basically all these three parties will make the money transfer from one people to another people. So that is the finance is all about. So another definitions on finance, it is finance involve the same types of decisions. How firms raise money from investors, how the firms invest money in an attempt to earn a profit, and how they decide whether to reinvest the profits in the business or distribute them back to the investors. All right, so they talk about the businesses. So business, if they want to raise the money, with this money, they use it as a capital. All right, from this capital, they will do the business. So when they do business, they will expect profits. So from the profit they receive, they will decide whether this profit will be distributed to the investors or they will use this profit to reinvent the business. To basically reinvent means that they invested back into the company. So when they invest into a company, the company will have a larger capital and the business can be larger. So we call it as a growing of the business. They want to grow the business. So how the business can grow the can grow the business? By having a profit. They use the profit as part of the capital. So that's how the decision making of a corporations. So another definitions on finance. Finance is the art and science of handling money. So the third definition is more general because everyone in this world, they will involve with finance decisions every day. Where to spend the money, what things that we should buy and what things that we should not buy. So what are the things that we want to spend for the money? So how we are use the money is the art of handling money. So there are people who just spend their money for unnecessary things, and there are also people who spend money for things that can make their money growing. So how these people how these different types of people handle the money. All right, because money, it is not something that you need to love. Money is something that you need to use. All right, so there are things that useful things and the things that you love. So there are the value on that. All right, so people who learn finance, they should understand finance better compared people who not learn finance. All right, so that is the definitions on finance. So category of finance. So there are personal finance, there are public finance, and there are also managerial finance. So personal finance is basically more on individual as a person. So that it's personal finance. Personal finance, it involves how a person, what types of loans that is available in market for individuals. All right, so that is personal finance. Okay, so how the government will protect the personal finance on the individual. So basically, if a person have problems in paying the debt, so they will go to a KPK, for example. So that is personal finance. That is the matter of personal finance. Okay, so public finance, it's more on corporations, right? It's more general to a people as a whole in a country. So that is public finance. And the third one is the managerial finance. So managerial finance is it is more on corporations and government, how they are going to manage the finance of the corporations or the institutions. So that is these are the categories of finance, right? So decision functions of financial management. So the first one is for investment. So whenever we want to do the investment, we have first and foremost, we have to have the person itself need to have the capital. So with this capital that they have, they will decide where to invest. So without capital, don't talk about investment. All right, so that is investment, because there are people who love talking on investment that, but yet they don't have any capital on that. So what you say is just nothing. All right, working capital investment decision is more on the routine. It's more on the daily routine. All right, so that is investment. So investment is how to grow the money. So that is investment. So how to grow the money? We need capital to grow the money. So without capital, we're not able to grow the money. So that is the first thing. Second is financing. How people deciding on the financing. What is financing? Financing is a loan, or another word, we call it as a borrowings. So borrowing, there is few sources of borrowing. So for personal, for individual, the source of financing would be hire purchase, home financing, or personal loan. That are the individual source of financing that available in commercial banks. But for corporations, there are another types of financings. So that one we will learn later on in the source of financing. So, but basically, what is financing? Financing, we need to know the sources of financing. So this source of financing is to use for capital, okay, as an initial investment. So how this capital can be used to increase the money. So we call it, so it's also called as borrowings or capital. So the borrowing is used to it is used for the capital to increase the value of the money for tomorrow. All right. So once we have money, we have to do the asset allocation. So we call it as asset management. If we're not able to manage the asset, so this asset will be not utilized. So the full utilized asset will be able to generate profits. So these profits will increase the value of money for future. So it is the most effective asset management will enable the business to grow faster. All right. So these are the three main elements in decision. These are the three main elements of uh, financial management. But basically, financial management, it's all about decision making. So in this decision making on what? On investment, financing, as well as asset management. All right. So finance within the organization. So who are the people? Who are the people who work on the finance in an organization? So it will start with the board of directors. So under board of directors, there are chief executive officer, CEO. Under CEO, there are two person, which is chief operating officer and also chief financial officer. All right. So the rules of COO, chief operating officer, they will do the marketing, production, human resource, and other operating departments. So it depends on the organizations, because if the organizations is bigger, the chief operating officer might be a different person. For example, marketing, there is one officer. Production, there is one officer. Human resource, there is another one officer. So it depends. It depends on the size of the firms. All right, if the firms is just a small firm, so all these rules will be uh, will be uh, will be will be conducted by only one person. All right. So second person is chief financial officer. So CFO. This person will be responsible to control all the financial elements of the organizations. They will do the accounting, treasury, credit, the legal, the capital budgeting, as well as the investors relations. All right. So these are the finance, how the finance within the organizations. All right. So next is about the parties in the financial environments. So who are there? So it starts with the financial manager. So without financial managers, others have will not be in the market. All right. So it starts with financial manager. Then we have the financial institutions, and in financial institutions it also have a financial market, and then there are investors. All right, so let's look who are these four parties. So let's look for financial manager. So financial manager is a person who make a decision. All right, so this person, they will make a decision to invest or to make financing. All right, who invest fund to expand a business and obtain funds, which is get a financing for the business. So that is the first role of the financial manager. They have to make decision that will maximize the firm's value and the stock price. And then for the financial management, the action taken by financial manager is to make financial decision for a firm. So basically everything with regards of the finance will be done by financial manager. So the role of financial manager is very big, because they need to deal with finance, and financial decision will be happen every day. So these are the things, like it's very crucial, because if you make wrong decisions, you will make a wrong ways lah. Okay, so there is a possibility that the company will face losses if the financial manager not wise in making decision. All right, so basically functions of financial managers, they need to have the ability to forecast the futures and then planning what to do. All right, so that what they target in the future will happen. All right. Second is to invest and do the financing. Investment is to spend the money where it is expected to give returns. Financing is to gain, is to apply for borrowings. So which borrowings is the lowest of the effective annual rate. It means that which borrowings give the lowest interest rate to pay, because all the borrowings, all the financing, there is cost associated with that. So financial managers need to be able to identify which financing is the lowest rates to pay. All right. So we have all these. The financial managers also need to have the ability to coordinate and control what they plan. And then with all these, they need to deal with the financial markets. So anything, if the financial manager decide to borrow, if the financial manager decide to issue shares because they want to increase the financing, they decide to issue shares, for example. So which market that they need to enter. So the financial manager need to understand the rules and regulations that they need to enter. The second is investors. So basically, investors is a person who have money and they will put their money in a place where they believe that can give return. So these are investors. So investors is the individuals or financial institutions that provide funds to firms, government agencies, or individuals who need funds. All right, individual investors commonly provide funds to a firm by purchasing their securities. It can be either stocks and debt securities, any financial instruments lah basically. Institutional investors are the financial institutions that provide investment funds. As for you to have a clear understanding what is in who are the investors, investors is the person or any parties who have surplus in fund, they want to grow the money. So that's it. They put the money in a place that they believe that can give a potential return to them. So they are investors. All right. Next, that involved in the financial environment is financial institutions. So financial institutions is a intermediaries between a person who have surplus in fund and a person who has shortage in funds. So these two parties, the person who have shortage and in fund and a person who have surplus in fund, they can be individuals, businesses, and governments. So how these people interacted to each other is through financial institutions. So for example, you save your money in Maybank, for example. You save money in Maybank and suddenly your friend want to apply for housing loan. So they go to Maybank and ask for housing loan. Did you interact directly with your friends? So the answer is no. You not interact with your friend directly. So both of you will go to the same bank. So that's why we call financial institution is a intermediaries between a person who has surplus in fund and a person who have shortage in fund. Those who have surplus in fund, they will go to bank and save money. They invest money. They can put the money in fixed deposit account or saving account. Bank, they will not keep this money. They will use this money to invest in another place, or they will use this money to give out as loan to the person who are in need for money. All right. So that's why we call financial institutions as a financial intermediaries. So in general, individuals are the net suppliers of funds, while businesses and governments are the net demanders of funds. Right? Why Is that so? Because usually who will take loan from banks or firms as well as governments. So financial markets, so what is the difference between financial market and financial institutions? Financial institutions is a place, for example, Maybank, CIMB Bank, Affin Bank. So those places we call it is financial institutions. So financial market is a tools that each of the financial instrument can be transacted. All right. For example, bond will be transacted in a capital market. Bond and share will be transacted in capital market. Money market is a financial instrument for short-term financing to be transacted. So different types of financial instruments will be transacted in a different places of market. Okay. So for example, I come up with this analogy because so that you have a better understanding on this. For example, laptop will not be transacted in pasar malam. Pasar malam is only things that like foods that will be transacted in pasar malam. But for laptops, you need to go to shopping mall. Then you can find laptops if you want to buy and sell laptops, for example. So same goes to financial instruments. Different types of financial instruments, you need to go to different markets to do buying and selling on that. Okay, so one of the financial market is called capital market. So capital market, there are two types of market. The first one is primary market and the second one is the secondary market. So primary market is the first time issued shares that will be transacted in primary market. So for example, company A want to issue a new issuance of shares. They're not able to issue that anywhere, but they only can issue that shares in primary market. Any other market, any other places, they will not able to sell this share. So the first introduction of a shares will be done through primary market. Okay, so once it's issued, once it is bought by any investors, so these investors don't want to hold that shares anymore. So they want to sell these shares. So where they can sell this share and allow any new investors to buy these shares, it will be happen in secondary market. So that is the differences between primary market and secondary market. So primary market and secondary market, it is capital market. Okay, only capital market have primary and secondary. Okay. So the next market is money market. Money market is for short-term financing, for short-term financial instruments. So that will be available in money market. Example for example of instrument that is transacted in money market is marketable securities. So a marketable security can be T-bills, T-bills actually is a treasury bills lah. Okay, so it is short-term financial instruments. So capital market, there are bonds and also shares. Shares, there are bonds and equity. So equity, there are common shares and also preferred shares or preferred stock. Both are the same things. Preferred shares or preferred stock, both are the same things. All right, so that's all for financial environment. So please remember, financial environment, there are four parties. The first one is the financial market. Second is investors. So these two parties will be transacted in financial institutions and also financial market. So what are the differences between financial institution and financial market? Market is the places that allows the transaction of different types of financial instrument, while financial institutions is the place where the financial market can be done. Okay, so all this information, uh, all this information reflect with the government, reflect the government, individuals, and also firms. And the most parties that will involve with all these things are the firms. So firms, there are three forms of firms. So the first one is sole proprietorship, which is the owner, there is only one owner. Second is partnership. Partnership, the owner will be more than two. It is two and more. And the last one is corporation. So corporation, it is belongs to public. The owner of the company is belongs to public. So that is corporations. Okay. So let's go to sole proprietorship first. So sole proprietorship is an unincorporated business, and it is owned only by one individual. So going into business as a sole proprietor is easy because only one person begin the business operations. So why it is easy? Because it's not involved with a lot of decision makers. Because there's only one absolute decision makers for the business. So that's why it is easy. Okay, so there are advantages and disadvantages on this. So the advantages, they are easily and less expensive compared the other two types of corporation. So they are also subject into few government regulations, and they are subject to lower income tax than the corporations. All right, so these are the advantages for sole proprietor. However, the disadvantages, they have unlimited personal liabilities for the personal debts. So they can lose more than amount of money they invested in company. Because if they not separate the individual asset and also the company's asset, there is a possibility that everything that that they have will be gone due to bankruptcy. I'm talking about bankruptcy cases. So the life of business is limited to the life of the individual who create it. Okay, if the person who create the business, but they not able to inherit the business to anyone else, to their inheritance, so the life of the business will be easily shut down. It will be easily close. It is easy to close the business. Okay, because it depends. It also depends on the demand of the product and services that they offer. Okay, because when talking about business, there is up and down. So basically, there are products that seasonal. So when it able to create lots of demands, then the business is booming. But if the business not able to create the demand, the business will go down. So these are the things. So proprietorship have difficulty in obtaining large sum of capital because there is a lower, because the capacity and the capabilities of sole proprietorship is lower compared to partnership and also corporation. So that's why this type of business not able to increase more fund compared to the other types of business. So let's move to partnership. So partnership is a legal arrangement between two or more people who decide to do business together. So advantages for partnership, they are a bit easily and inexpensive compared to corporation, but still it is harder and more expensive compared to sole proprietor. All right. So they are also subject to few government regulations, but still it is more compared to sole proprietor. All right. And they are also subject to lower income tax than corporation, but still the income tax is higher compared to sole proprietor. Right. So basically it advantages of partnership. The advantages for partnership, it is more similar to sole proprietor, sole proprietorship. All right. So what are the disadvantages for partnership? All of the partners are subject to unlimited liabilities. So the case same as proprietorships, but the agreement is a bit different because each of the person, each of the owners are the owner of the business. They are the owner of the business. All right. So another disadvantage is difficult to raise large amount of money, but still it is higher compared to sole proprietor. So for example, sole proprietor only able to raise up to 100,000, but for partnership, maybe they can raise the amount of the financing up to 200,000, but still it is better. Still it is higher and larger compared to sole proprietor. So if one partner draw from the partnership, the business has to close. So these are the things they need to have mutual agreement with all owners. All owners, when all owners agree to do something, then they can come out with the decisions. If any of the parties not agree to do on something, they cannot do that. Or the worst case, if any of the partners want to withdraw, all of them have to close the business. So these are the disadvantages of partnerships, because when there is more than one owner, the decisions also can be more than one decisions, because there is a lot of head in the business. So it's not easy. That. So corporations. So corporations, there is an arrangement between shareholders and also management. Then they come up with corporation. So who are the owner of corporations? They are the shareholders. Shareholders represent ownerships of a company. So how much is the share that they hold? It represents the ownerships of the company. If Encik Ahmad, for example, if Encik Ahmad own 70% of company A, B, C, so Encik Ahmad have 70% of C towards the ABC decisions. So that is the difference lah between corporation and another two type of business, because the owner of the business is belongs to public. All right. So who are the public? The public is shareholders. All right. Shareholders is representing the ownerships of the company. And yet, who are the management? Management are the person who manage the business. They are responsible to ensure that the business is making profits. All right. So to make it in one word, to make it in a better word, so what is corporation? Corporation is a legal entity created by a state, separate and distinct from its owners and managers. So the management and the owners are different person. Okay, are different entity. Sorry, they are different entity. Okay, so management act as an agent to the owner, which is the shareholders of the firms. All right. So these are the definitions on the corporation. So advantages: have unlimited life, easy transferability of ownership, because if you don't want to hold the owner, if you want to hold the shareholders, you can just sell that shares to another parties. So that person will be the new owners of the business. And limited liabilities. Disadvantages: double taxation, more government supervisions, and difficult to establish because it is subject to more regulations and documentations, right? So these are the goal of firms: wealth maximizations. It is shareholders' wealth lah, basically. So that's all. All right. So that's all for chapter 1.